Everybody, welcome to Intermediate Accounting 17th edition video solution for problem 1410. This is the Intermediate Accounting textbook 17th edition. Authors Don Kiso, Jerry Weingant, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 to 2022 by myself, Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are mine, or Bennett Tchaikovsky, and not the authors of the textbook or Wiley. Let's get to problem 1410. Okay, so we have various different situations, and let's go ahead and take a look at this right over here. So on March 1st, 2021, Wilkie Company issued at 103 plus accrued interest, $4 million, 9% bonds. The bonds are dated January 1st, 2021 and pay interest semi-annually on July 1st and January 1st. In addition, Wilkie incurred $27,000 of bond issuance costs. Compute the net amount of cash received by Wilkie Company as a result of the issuance of the bonds. So the cash they're going to be receiving, it was issued at 103. So I'm going to take 4 million. We'll do cash for the bond issuance. This is going to be 4 million times 1.03 or 4,120,000. So this is going to be 4 million times 1.03. We're also going to receive cash for the accrued interest. Okay, so right over here, the face amount of the bonds is 4 million. The bonds pay interest at 9%. They pay interest semi-annually, so we're going to multiply this by 0.5. But also at the same time, 2 months have passed. So we can either do by 0.5 or we can do 2/12 for January and February. So the annual interest for this bond is going to be $360,000. So for the 2 months, this here is going to be $60,000. Okay. Okay. So the total cash received. Right over here, though, however, I have 27,000 of bond issuance costs of 27,000. So my net cash received is going to be 4,180 minus 27,000 or 4,153,000. Okay, so one of the questions I have is how do we go through an account for bond issuance costs? And let's check this out over here. Okay, so bond issuance costs are the fees associated with the issuance of bonds by an issuer to investors. The accounting of these costs by capitalizing them and charging them to expense over the life of the bonds. So these costs are recorded as a deduction from the bond liability on the balance sheet. The costs are then charged to expense over the life of the associated bond using the straight line method. So what we can do is this over here. So this is going to be kind of showing up over here as a discount or like essentially as a contra liability, reducing the carrying value of the bonds, and then we would go through and amortize it. Okay, so this is part A. I'm just going to go ahead and put this right over here. So in case we want to go back and take a look at this later. So we got bond issuance costs. So that's part A. Okay, so for part B, Langley issued 9% bonds with a face value of $700,000 for $656,992 to yield 10%. The bonds are dated January 1st and pay interest annually. What amount is reported for interest expense in 2020 related to these bonds, assuming Langley used the effective interest method for amortizing the bond premium and discount? Okay. So what's interesting, so it doesn't tell us about anything about how many years it is, but based on the information, we can kind of figure out what's happening. So on 1/1/20, I debit cash for $656,992. I always credit bonds payable at the face amount. So my discount on bonds payable is going to be the difference between these two, or $43,008. Okay, so the bonds are dated January 1st and pay interest annually. What amount is reported for interest expense in 2020 related to these bonds, assuming Langley used the effective interest method? So for the effective interest method, we're going to take the carrying value. My carrying value is going to be my bond payable minus any type of discount, or the carrying value. I'm going to take this, and this will be 12/31/20. My market rate of interest is going to be 10%. So my interest expense is going to be $656,992 times 10%. The amount of cash being paid for interest is going to be $700,000 times 9%, or $63,000. So the difference is going to be my discount amortization. Okay, so my cash paid, so my discount amortization is going to be my interest expense minus my cash paid. And so my carrying value my ending carrying value for this bond will be $656,992 plus the $26.99.20. Remember, if we have a discount, it's going to be writing up the carrying value of the bond. So the answer to this is, what's the amount for interest expense if we use the effective interest method? So $65,699. Okay. So Tweedy Building Company has a number of long-term bonds outstanding at December 31st, 2020. These long-term bonds have the following sinking fund requirements and maturities for the next 6 years. So with this one, I actually went through and I kind of looked up, not necessarily really cheating, but I went through and there's a page, or there's a section that is in the textbook. Wow, I'm actually referencing a textbook. That's absolutely amazing. So there's a section in the textbook that talks about the disclosure for bonds. And with that disclosure, what we're really looking to do is we want to be talking about what's going to be happening over the next 5 years. And so if I look at this over here, just give me a moment. So over here, if I take, I'm going to go ahead and do a little shift. By the way, this book is available free on Z Library. That's where I picked it up from. So if I come down over here, okay, so companies that have large amounts of numerous issues, okay, long-term debts within 1 year is a current liability. Okay, so over here, the key thing that we're looking for is no disclosures. Companies should show any assets pledged. Okay, so here you go. Finally, companies must disclose future payments for sinking fund requirements and maturity amounts of long-term debt during each of the next 5 years. So that's really going to be the key, is we want to talk about the maturity basically for the next 5 years. And these disclosures will in fact help people out with the timing of the cash flows. As an investor will probably want to know, can this company meet its obligations? Okay, so over here, what I'm going to do is I'm going to say, what we'll do is we'll say right over here. So we've got 2021. And the way the book is showing the answer to this is they're combining basically both the sinking funds and the maturities. So Tweedy, TWC has the following maturity and sinking fund requirements for the next 5 years. Okay, so right over here, we've got 2021, 2022, 2023, 2024, and then we've got 2025. So this here is going to be 400,000, 350,000, 200,000. 2024 is 200,000. And then over here, we've got in 2026, there's like a thereafter, or 2025 is going to be 350. And then thereafter is just showing the maturities. Okay, so a sinking fund is a requirement for companies to go through and to set aside funds in order to fund the future repayments of bonds. So how should this information be reported on the financial statements as of December 31st, 2020? So you would essentially kind of go through here and show this. Honestly, if I got a question like this in real life, I've never had to deal with it. I would go to the sec.gov and I would look at the requirements of a company in terms of its obligations. And let's go ahead and do that. So this is probably, I wouldn't really, and again, KISO this is what's really hard about writing an accounting textbook, is that no textbook is as good as what you're going to go through and see on public filings. And right over here, you've got debt maturities. And in fact, we're going through and showing this out even further. So for Target or Target, you've got over here, so commercial paper and long-term debt, excuse me. Wow, it's getting to be sleepy time. Commercial paper and long-term debt, they're showing it out over the next 30 years. So this is kind of a required principal payments. This again is showing, this is where you would really go in terms of looking for the disclosures of debt. So if you get into a situation like this in real life, you want to go ahead and take a look at something like this rather than your intermediate accounting textbook. Okay, so in the long-term debt structure of Beckford, the following 3 bonds were reported: mortgage bonds payable, collateral trust bonds, and bonds maturing in installments secured by plant equipment. Determine the total amount of any of debenture bonds outstanding. So debenture bonds are essentially those bonds that are backed by themselves. Okay, what is a debenture bond? So unsecured by collateral. So a debenture is a type of bond or other instrument that is unsecured by collateral. So when we look at this over here, a mortgage bond is going to be secured by property. A collateral trust bond, again, collateral, it's secured. Bonds maturing installments secured by plant equipment. So right over here, none of these bonds are going to be considered to be debenture bonds. So with the power of Google looking up a lot of this is what you're going to be doing in practice. So that's the answer to part D. In any event, have a great one. I want to thank Wiley for allowing me to go through and to use the videos. Please don't forget to like and subscribe. And if you want solutions to any of the other questions, please feel free to ask for them in the comments. Have a great one.